Welcome to Breaking News to Trading Moves. I'm your host, and today we have a specific transaction to discuss that alters the leaderboard in the United States connectivity sector.
Yeah, it's the one the market has been waiting for, really.
Right. We are looking at a finalized agreement between two major operators. The headline is clear. The U.S. Federal Communications Commission, the FCC, has officially approved Charter Communications' acquisition of Cox Communications.
And we have the specific numbers attached to this now. We're looking at a price tag of $34.5 billion.
34.5.
Exactly. That is the exact figure Charter is putting up to bring Cox into the fold.
And when you put two companies of this volume together, the immediate result is scale. We're talking about becoming the largest in the country.
Scale is the primary driver here.
Yeah.
The immediate result of this $34.5 billion transaction is that the combined entity becomes the single largest cable TV and broadband provider in the United States.
Which is an entirely new dynamic for the market.
It is. We are talking about a combined subscriber count of roughly 38 million.
38 million. That is a number that stands out when you are looking at the U.S. map.
It does. Because, for context, you have to realize that number allows this new combined company to top Comcast in terms of total subscribers.
And Comcast has always been the benchmark.
Right. For a long time, Comcast has been the baseline for volume in this industry. This deal changes that metric entirely.
So we have the headline and we have the price tag. But the opportunity for you listening is in understanding who benefits and who faces new pressure when a deal like this actually goes through.
Yeah, the market reaction is where the focus needs to be.
Exactly. Today, we're going to break this down for you. We're going to look at the deal terms and the specific conditions the FCC attached to this approval. Then we are going to move directly into the market analysis. We have a list of winners and losers, specific ticker symbols, and sector impacts that you need to know.
And we need to look at the hardware side of this, too, because it is not just about the cable bills going to the consumer.
Right. It is about the infrastructure, the fiber and the contractors doing the actual physical work.
Exactly. So let's get into the structure of the deal itself. We know the price is $34.5 billion. When does this actually close? Because these things don't happen overnight.
No, they don't. The expected closing time frame is mid-2026.
Mid-2026. So we have some runway here.
We do. These transactions take time to finalize even after regulatory approval, but that mid-2026 mark is the target date the companies have firmly set.
And beyond the cash price, there's the balance sheet to consider. Charter isn't just buying the assets, they are taking on the liabilities, too. You have to look at the debt.
Correct. Charter will assume approximately $12.6 billion of Cox's net debt and other obligations.
$12.6 billion in debt assumption.
Right. When you are modeling this out, you have to look at that enterprise value, not just the equity check. That debt load is a very real part of the package. Now, whenever we see consolidation like this, the companies involved always discuss efficiency. They tell the market how much money they're going to save by being one company instead of two. What is Charter projecting here for their savings?
Charter has put a specific number on it. They are stating an expectation of about $500 million in cost savings.
$500 million.
And they expect to realize that within 3 years of closing.
Within 3 years. That is a measurable target for investors to hold them to.
It is. Usually that comes from eliminating duplicative systems, streamlining overhead, combining purchasing power. It is the standard approach for M&A in the cable sector.
Let's talk about what the customer is actually going to see. Usually in these deals, the acquired brand disappears. If I'm a Cox customer today, am I going to see a Charter logo on my bill in 2027?
The branding strategy is actually distinct here. The parent company plans to rebrand to Cox Communications within 1 year of closing.
Wait, so the parent company takes the Cox name, not Charter?
Yes. For the corporate identity, it will be Cox Communications.
That's unusual.
It is, but there is a caveat. Spectrum will remain the main consumer-facing brand.
Okay, so the consumer sees Spectrum.
Right. So if you are subscribing to the service at your house, you are likely interacting with the Spectrum brand, even if the corporate holding name changes to Cox.
That is a detail worth noting.
Yeah.
It suggests they see value in the Cox heritage, perhaps on the business side, but Spectrum is the established brand for the household. And speaking of the household, why is this deal happening right now? What is the driving force behind this $34.5 billion move?
It comes down to market dynamics. We call it the fight for the household.
The fight for the household.
Yeah. If you look at the last decade, the dynamic has shifted. It used to be cable versus satellite. Now it is a battle of bundles. You have the broadband plus mobile bundle on one side, which is exactly what Charter and Cox are pushing.
And on the other side.
On the other side, you have streaming plus wireless options.
Okay, so the consumer has a choice to make.
Exactly. The consumer has to decide, do I get my internet and phone from the cable company? Or do I get my internet from a wireless carrier and buy my entertainment separately? This transaction is about fortifying that broadband plus mobile offer.
It is about retention, keeping that customer locked into their specific ecosystem.
Precisely. That is the entire strategy.
Now, the FCC didn't just approve this without input. They attached requirements to this approval. We mentioned earlier that there are conditions. What does Charter specifically have to do to make the FCC happy?
This is critical for anyone analyzing that $500 million savings number we discussed earlier. The FCC attached specific requirements regarding network upgrades and jobs.
Jobs specifically?
Yes, there is a specific mandate for a $20 per hour minimum wage extension to Cox workers.
$20 an hour. That is a fixed cost going forward.
It is an absolute fixed cost, and there are commitments to upgrade the network on top of that. So the debate in the market right now is the synergy question.
Meaning, how much of that $500 million in savings is actually retained by the company?
Correct. How much is gross synergy and how much is what we call synergy minus conditions?
Right, because you have new expenses.
Exactly. If you save money on back office overlap, but you have to pay more in wages and spend more on capital expenditures for these mandatory network upgrades, the net benefit is very different.
So if you are an investor, you have to do the math on the cost of the wage hike and the upgrades and subtract that from the $500 million in savings.
That is the calculation you have to run. It is not just a straightforward addition to the bottom line. You have to account for the FCC's specific requirements.
Let's transition to the winners here. When a deal of this size proceeds, it sends a clear signal to the rest of the sector. We are categorizing this first group of winners under cable consolidation and scale.
The premise here is that consolidation is essentially a green light. The fact that the FCC approved this reduces the perceived deal risk for other potential combinations.
It sets a precedent.
It does. It puts consolidation back on the agenda for the whole industry.
And generally speaking, in the cable business, scale matters. It is a volume game.
Scale is the central metric. When you are larger, you have better pricing power. You can negotiate better rates for the content you put on your TV packages. You have more leverage when buying the actual equipment, the routers, the modems, the fiber.
And how does scale affect churn, customer retention?
You get lower churn via bundling. The more services you can sell to a single household internet, TV, mobile phone, the less likely they are to leave. A larger entity simply has more tools to create those sticky bundles.
So let's look at the specific tickers you need to watch. The acquirer is obviously the first one.
Right, that would be Charter Communications. The ticker symbol is CH-TR.
CHTR.
They are the primary acquirer. They are the ones who are going to realize the direct benefits of these scale arguments. If you follow the thesis that scale wins in cable, CHTR is the direct way to look at it.
And there's another name that comes up in these consolidation conversations related to the broader structure of the industry.
Yes, Liberty Broadband. The ticker there is LBRDK.
LBRDK. Why are they included in this winners category? They aren't buying Cox.
No, but it's about the overarching theme. Contextualizing their inclusion in the winners category is part of that broader consolidation narrative. If the FCC is open to deals of this magnitude, assets like Liberty Broadband become more relevant.
It makes them a potential piece of a future puzzle.
Exactly. It puts them back on the table across the sector as investors look for how the pieces might fit together next.
So LBRDK is a way to look at the sector sentiment regarding M&A. If the market believes more deals are coming, that ticker benefits.
That is a very fair assessment.
Let's move to the second category of winners. This one is less about the corporate structure and more about the actual technology running the internet. We're calling this network upgrades and fiber buildout.
This ties directly back to those FCC conditions we were just talking about. Charter has committed to investing billions to upgrade the network in Cox's footprint.
Right.
They have a mandate to deliver faster broadband. That isn't just a PR statement. It requires physical hardware.
We are talking about the tech stack required to make the internet faster.
Specifically, optical transport, fiber, switching, and routing gear. You cannot make the internet faster without upgrading the physical equipment that handles the data.
So who actually makes the gear? Who sells the equipment in this scenario?
One of the key beneficiaries of optical transport and fiber spending is Ciena.
And what is the ticker for Ciena?
The ticker is CIEN.
CIEN.
Ciena specializes in the equipment that allows data to travel over fiber optics. If Charter is upgrading the Cox network to handle more speed, they need the kind of optical transport solutions that Ciena provides. It is a direct line from the FCC condition to Ciena's potential revenue.
And what about the switching and routing? The brains of the network directing all that data.
For that, you look at Arista Networks. The ticker is ANET.
ANET.
Arista is a major player in high-speed switching and routing. As the network density increases and the speed requirements go up because of this deal, operators need to upgrade their core switching gear. Arista is perfectly positioned to capture that procurement spend.
So we have CIEN for the transport of the data and ANET for the switching. These are the companies that receive the purchase orders when Charter starts spending those billions on upgrades.
Exactly. The regulatory mandate drives the capital expenditure, and these tech companies provide the required technology.
Now, you can buy all the fiber and switches in the world, but someone actually has to go out there and install them. That brings us to our third category of winners, which is last-mile construction and contractors.
This is a segment that is often overlooked by the broader market, but upgrade faster speeds implies physical plant work. It is not just a software update that you push from a server. We are talking about actual fiber expansion. We are talking about node splits.
Explain node splits for a moment for those listening. What does that actually involve in the real world?
Sure. A node is where the main fiber network meets the neighborhood's local lines. If you have too many households on one single node, the internet speeds slow down during peak hours.
Like traffic on a highway.
Exactly. To fix it, you split the node. That means physically running new lines, installing new equipment cabinets on the street, and dividing that neighborhood into smaller, faster clusters.
And that means construction.
It means heavy construction. It means field deployment. It means trucks rolling down residential streets.
And the cable companies, Charter and Cox, they don't usually do this with their own internal staff, do they?
Not at this scale, no. They hire specialist contractors to handle the volume of work.
So who are the public companies that do this physical work?
The first one to look at is Telecom Industries. The ticker is DY.
DY, just 2 letters.
Right. Telecom is highly focused on this exact type of project. They do the last-mile construction, the outside plant work. If Charter is working on the physical plant in the Cox territory, Telecom is the type of firm that bids on and wins those multi-million-dollar contracts.
And are there others in this space with the capacity for a job this big?
Quanta Services is another major one to watch. The ticker there is PWR.
PWR.
Quanta is a broader infrastructure contractor. They do a lot of utility work, electric power grid stuff, but they are also very active in telecommunications infrastructure deployment. They have the national scale to handle the kind of multi-state upgrade cycle Charter is initiating here.
So DY and PWR are the companies putting the hard hats on and handling the physical installation.
They are. The capital moves from Charter to the equipment makers like Ciena and Arista, and then it flows right to the contractors who install it.
We've covered the winners, the hardware, the contractors, the acquirer. Now we have to look at the other side of the ledger. Whenever there is consolidation of this size, there is new competitive pressure. Let's talk about the losers, and we are starting with the wireless carriers.
This goes right back to the fight for the household we discussed at the top. The premise here is the threat of tougher cable bundles.
Because Charter and Cox both have mobile phone services now. They aren't just internet providers anymore.
They do. They have both pushed mobile offerings independently over the last few years, but a combined larger player can operate very differently.
In what specific way? How does size change their strategy?
With aggressive broadband to mobile bundling, they can go to a customer and say, if you take our gigabit home internet, we will give you a mobile line for a specific, incredibly low price. They can use the high margins from the broadband side to subsidize and support the mobile side.
And that directly impacts the wireless incumbent.
It absolutely raises the heat for the big wireless carriers. It puts pressure on their subscriber base because the cable company is offering a bundled discount they can't easily match.
So who are we looking at here? Who feels the heat?
T-Mobile US is one. The ticker is TMUS.
TMUS.
T-Mobile has been growing steadily, but they are vulnerable to aggressive mobile pricing from cable operators who can bundle that mobile plan with a wire to the house.
And the other major player.
Verizon. The ticker is VZ.
VZ.
Verizon has a massive subscriber base to defend. As the new Charter-Cox entity utilizes promotions and discounts, Verizon faces direct competitive pressure. They have to make tough decisions regarding pricing and retention to keep those customers who might want that single, cheaper bill for internet and phone.
It really affects their pricing flexibility. They can't raise rates if Charter is offering a cheap bundle.
It does. It introduces a highly price-sensitive competitor with massive national scale.
Let's move to the next group of losers. We talked about the giants like Verizon and T-Mobile, but what about the smaller cable players, the smaller and regional competitors?
This is purely a scale issue. The premise here is the extreme disadvantage of smaller operators competing against a scaled number 1 player.
What is the primary disadvantage for them?
It is the spending gap.
Yeah.
A company the size of the new $34.5 billion Charter-Cox entity can afford things the smaller regional operators simply cannot.
Like what? What are they outspending them on?
More spending on promos, for one. They can run aggressive discount promotions for longer periods. More spending on retention if a customer calls to cancel. Charter can offer massive credits to keep them. And critically, more spending on network upgrades to offer faster speeds.
So if you are a regional cable company operating in a market right next to this new entity or overlapping with them, the environment changes overnight.
It becomes much more difficult to survive. In overlapping or adjacent markets, the pressure increases exponentially.
Who are the tickers to watch in this regional space?
Wide Open West is one. The ticker is WOW.
WW.
They are a smaller operator. They face increased pressure because they just don't have the balance sheet to engage in a prolonged price competition against a giant acquirer.
On the other hand.
Cable One. The ticker is CABO.
CABO.
Same dynamic. They are an operator in specific regional markets, but competing with a newly consolidated giant challenges their growth and retention metrics. They are forced to defend their turf against a company with vastly more resources.
It is a serious challenge for them. Now, our final category of losers. We are listing streaming platforms. This one might surprise some people.
It is a specific point, but a vital one.
Right.
We are calling this the traditional bundle defense.
Explain that defense. How does a cable deal hurt a streaming platform?
The deal is explicitly framed as cable and broadband operators battling streaming companies. The entire narrative is about aggregation.
Aggregation, bringing everything into one place.
Exactly. If the new Charter-Cox entity can create a more competitive broadband and bundle package, maybe by integrating some streaming services directly into their interface, or just making the total price of the connection plus the traditional TV content attractive enough it can actually slow cord cutting at the margin.
So if the traditional bundle holds its value better because of this scale, the customer might not cancel their cable subscription to go purely to a platform like Netflix.
Exactly. Or the cable company becomes the primary aggregator. It strengthens the aggregation story for cable. They keep the customer within the traditional ecosystem longer rather than letting them escape to an all-streaming diet.
So which streaming platforms face friction here?
Netflix is the primary one to watch. The ticker is NFLX.
NFLX.
If these new cable bundles become more attractive, the pure-play streaming growth might face some real resistance. It is about the friction it creates for acquiring new subscribers.
And there's another media entity involved here, one with a lot of traditional channels and a streaming platform.
Warner Bros. Discovery. The ticker is WBD.
WBD.
They are a platform that faces this strengthened cable operator dynamic. They rely heavily on traditional distribution. If the distributors, like the new Charter, get stronger and larger, they have far more leverage over the content owners, like Warner Bros. Discovery during carriage negotiations. It is a definitive shift in the balance of power.
So we have covered the deal structure, the winners in hardware and construction, and the losers spanning wireless, regional cable, and streaming. As we wrap up this analysis, what should you, the trader listening to this, be watching? What are the levels to watch?
For Charter specifically, you watch the deal arb, the arbitrage, and you closely watch the narrative of synergy versus integration costs.
The math regarding the $500 million in savings and the expenses of the FCC mandates.
Yes. Watch for any news on the network capex and the wage commitments. If those costs run higher than expected, the entire synergy thesis changes.
And for the equipment side, Sienna's and Erstas.
For the equipment and contractors, CIENANETDY, look for forward commentary. Listen to their quarterly reports. Are they talking about the timing of upgrades? Are they giving clear guidance on CapEx cadence leading into 2026 and 2027? That is where the actual revenue appears.
And finally, the wireless sector.
Watch for data in the following quarters regarding promotional intensity. Are T-Mobile and Verizon increasing their advertising spend? And look closely at the bundle churn data. If cable starts taking real mobile share from them, it will show up first in the churn numbers of the wireless carriers.
That is the complete roadmap, a $34.5 billion transaction, creating a new leader in the connectivity sector, with massive implications for hardware, labor, and competitors across the board.
It is a classic consolidation transaction, but the specific FCC conditions make it a unique setup to watch.
We will be tracking it all the way to the closing in 2026. And it leaves you with something to consider. If this aggregation strategy works and successfully defends the household, you have to wonder what the next target is. Do these newly scaled giants stop at connectivity? Or do they attempt to become the sole digital gatekeeper for every single service entering your home? That is all for this session of Breaking News to Trading Moves.
Before we go, a mandatory reminder. This is not financial advice or buy or sell recommendations. This is purely the opinion of the author.
Thanks for listening. We will see you next time.